Hello everyone, in today's video we'll continue our discussion on the decision-making biases, but we will go through the emotional biases in investing. So by the end of this video, you will have a complete checklist of all the emotional biases that you might have while taking decisions and especially taking decisions in investing. Let's go through the complete list of the biases, and after we will discuss each of the biases in particular. And of course, if you want the PDF, you can always get it by subscribing to the free community that you will find in the description link below. And once you will join the community, just send me a DM saying, please send me the emotional bias checklist, and I will just do so. Okay, let's continue. So the first one is the loss aversion bias. The second is the regret aversion bias. The third is status quo bias. The fourth is endowment bias. The fifth is self-control bias. Sixth, optimism bias. Seventh, fear of missing out. Eighth, pride and regret bias. Nine, endowment effect. 10th, illusion of knowledge. 11th, self-enhancing transmission bias. And 12, emotional attachment bias. But before going through each of the biases individually, let's define what are the emotional biases. So emotional biases stems from impulses, feeling, and often resulting in impulsive or irrational decision making. Emotional biases are harder to correct because they are deeply linked to our personal feeling and intuition. Instead of eliminating emotional biases, individuals need to adapt to them by recognizing their presence and adjusting their decision accordingly. So let's go through the first emotional bias. It's the loss aversion bias. We saw already its counterpart in the cognitive biases. Here is the emotional side of the loss aversion. And in fact, is the emotional reaction to losses that can lead investors to hold on to losing positions, avoiding the pain of realizing losses. Here, the impact on investing is that loss aversion can prevent timely sales of underperforming assets, resulting in prolonging losses. An example can be that investor who held onto Enron until it collapses in 2001, hoping that it would rebound, suffered substantial losses. So here, very similar to the cognitive side, just shows the emotional side that is really a painful experience realizing the losses. And that's why underperforming assets tend to remain longer in the portfolio of people. And also, it's the case for myself. I need really to work on this loss aversion bias because I prefer to double down on a company, especially if I see that there is some value there. But I need to learn that I don't need to gain the money I lost from the same assets that caused my losses. I can gain my money back by investing in other assets. So it's something that I'm working on. Second one is regret aversion bias. Here is the fear of the future regret causes investors to avoid decisions they perceive as risky. This bias can lead to excessive caution or missed opportunities as investors avoid unfamiliar investments. Investors who avoided tech stock during the 2000s due to memories of the dot-com bubble missed significant gains from companies like Apple and Google. A regret aversion bias also can be, for example, investing in financials after the 2008 crisis, and also the missed rally in the Bitcoin if not invested at the beginning, even if exposed to. So this is something that occurred to me. I had the opportunity to invest in Bitcoin back in the days, and I did not recognize the value that this Bitcoin might have over the typical payment structures. Not saying that it's going to be there forever, but I could have seen the Bitcoin growing a lot. And at that time, I didn't even want to invest a small chip. So this was a little bit my personal experience of the regret aversion bias. Number 3, status quo bias. Here's where investors prefer to keep things as they are, avoiding changes that might disturb their current setup. Here, the bias leads to stagnant portfolios as investors avoid rebalancing or exploring new asset classes. An example here is that a conservative investor might keep all their assets in bonds, missing out on growth in equity over time. Emotional bias number 4, endowment bias. Here's where investors place a higher value on assets that they own, overestimating their worth relative to their other options. Here it can lead the investor to hold on to assets longer than necessary, even if their intrinsic value declines. An investor may hold on to shares for a long-term employer out of an attachment, even if the stock underperformed the market. Here, endowment bias, I tend to suffer from it because once I have it, I also tend to anchor the price and the value of my entry point, even if it's completely irrelevant. And as Peter Lynch said, the stock does not know that you own it. So it's really a human need to have a reference point, but it's not really relevant. It should be based always on the intrinsic value, not on references or the fact that you own the stock that is going to go up. So you need to be comfortable that when you buy, it can go down 50%. And I'm a little bit suffering from this endowment bias because I tend to increase the perceived probability of success just because it's in my portfolio. Also, by having it in my portfolio, I increase the attention that I dedicate to the company. So there is a counterbalance in there because if it is not in my portfolio, I tend even not to look at it. But now, once it's in my portfolio, I tend to give more attention to the developments and the company and the sector itself. So it's a balancing act there. Bias number 5 is self-control bias. Here's where the investor may struggle to balance short-term enjoyment with long-term goals, leading to impulsive spending or poor investment choices. Here is when poor control can lead to excessive spending and undersaving, harming long-term investment success. A good example here is where investor spends gain from a successful trade on luxury items instead of reinvesting it for future growth. I tend not to have this issue with my financial side. I have it more on the food side or on the drinking side. So if I go out and enjoy one beer, I tend to have not only one. So my self-control is not that strong there. But on financial side, I tend to keep my money always invested and not taking out that much. I tend to be a little bit restricted also on my spending and on the bonus that I get. I tend to reinvest everything as of now. So I tend not to do that much on finance. I don't know why, probably because it's mathematical. I can see the results, while the pleasures of eating or drinking tend to be much more complicated from my self-control side. Let me know if you have the same problem and also how you are solving it, because it's definitely something that I want to improve as well, not only on the financial side. Bias number 6 is optimism bias. Here is where investors tend to be overly optimistic about outcomes, leading them to underestimate the risk. The impact on investing is that this can result in riskier bets and insufficient portfolio diversification and increase vulnerability of downturns. An example is that in the leading up to the 2008 financial crisis, many investors were optimistic that the housing prices will continue to rise indefinitely, ignoring the underlying risk. Here is definitely something that I'm not really susceptible for, because as soon as something goes well, I'm very, very scared about the underlying emotions guiding the stock. So I tend to be more on the contrarian side than on the trend side. But I definitely see this occurring in the market. It's something that occurs every time there is a bubble, because every person see the trend and can only say, oh my God, it's gonna be better, it's gonna be better, it's different this time. So for me, I probably suffer it in the fact that I don't use it that much on in my investments to take advantage of it more than being suffering from it. So that's my current position there. Let me know if you're suffering about optimism bias. Also, it could be quite cool to understand what are the triggers of this optimism so that we can forecast it better, for example. Let's go to bias number 7 now. The fear of missing out, very similar to the previous one, to be frank, which it's where investors worry about missing lucrative opportunities others are capitalizing on, often leading to rash decisions. The impact on investing is that this bias drives herd behavior, as investors tend to follow trends without full analysis, potentially buying overvalued assets. The cryptocurrency surge in 2017 and 2021, so many people invest at peaks due to FOMO, leading to losses when prices corrected. I tend not to do this much, but once I really remember the feeling of missing out, that caused some rash decisions that at the end did not materialize, thank God, because the market was closed. But it was when there was the GameStop situation, especially on the option side. So to buy short-term call out of the money. So it was like a crazy, risky bet. But I was seeing all the people enjoying incredible returns around me, and I was really feeling this deep desire to take part of it. It was the first time that I felt it. It was the last time I felt it as well, because usually I tend to be contrarian. I don't know what was about it. I think the confluence of news, multiple days of height, the fact of fighting against someone. It was really a confluence of psychological causes that led me to be having this fear of missing out. Bias number 8 on the emotional biases is pride and regret bias. Here's where investors may feel pride in past success investments and avoid strategies that might lead to regret, sometimes resulting in inflexible or conservative decision making. Here, the impact on investing is that the pride in past performance can lead to overconfidence and repeated strategies without fresh analysis, while fear of regret may cause investors to avoid bold but prudent risk. As an example, an investor who profited by investing in a stable blue chip stock might hesitate to consider high growth technology stock, fearing regret if they perform poorly. Here, I might be subject to this as well, in the terms that I tend to stick to what I know, but also taking some risks here and there. So I really don't know if this plays for me or not, because I feel comfortable having a buffer of value on where to fall on instead of just going berserk on incredible growth opportunities. But let me know if you have a different strategy, how you feel about it, how you go about managing this bias. Bias number 9, illusion of knowledge. Here's where investors believe that they have more information or knowledge about an investment than they actually do, leading to overconfidence in their decision. This can drive investors to take greater risk than warranted by actual analysis, as they may feel that they have a unique insight in the future asset. Here, a big issue that I see a lot of retail investors doing is when they are reading few articles or watching the financial news, and they believe that this gives them enough insight to buy a company, enough information to buy a company, potentially really leading to poor stock selection. Usually, everything that is on the news, it's already priced into the stock. What is not priced is the long-term view of the company, understanding what are the recurring and operating earnings that are the normalized one that are most likely to continue in the future, because it's difficult to predict, and you need to have a long-term view, which usually big investors do not have unless they follow some certain long-term strategies. I used to be very hit by this kind of bias. Now I'm more aware of what I know I don't know, and I tend to play on the conservative side. I want to have enough buffer when according to my conservative valuation, that even if I'm wrong, I still don't lose much. Let's go to bias number 10. It's self-enhancing transmission bias. A fancy description of the phenomenon of I brag about all in my wins, but okay. Here occurs when investors are more likely to communicate and celebrate their successes than their failures, reinforcing a biased view of one investment skills. This bias can lead to unrealistic expectation and excessive risk-taking, as investors become overly assured in their ability due to the selective memory and sharing. As an example is when an investor frequently discusses only their successful trades with friends, creating an inflated perception of their skills, encouraging riskier future investments. So this is something that I tend to do at the beginning of my investment career. Also, I tend to do it from here and there, especially when I have some very good trades, and I tend to forget about the losses, especially because you take it as tax loss harvesting, etc. So it's definitely something I still need to work on. Maybe I need to print a yearly list of the top 10 losses that I did for the year, so that I remind myself every year of my actual decision making and what brought me to those decisions. And to conclude, emotional bias number 11 is emotional attachment bias. Here is where The investors develop emotional attachment to certain assets, especially when they have a personal connection to them. This emotional attachment can cloud objective judgment, leading to decisions that do not align with the investor financial goal. An example here is where an investor holds a share in a former employer or a family business, even though the company has diminishing prospects and better opportunities exist elsewhere, it will continue to keep it by reducing his future wealth. Other example of this that recently occurred to me by talking to some friends is that they really loved Spotify due to past performance, emotional attachment to this stock, and they are not willing to sell it ever. So this might or might not be a good choice, but the fact that it's driven by an emotion, that's definitely a bad process. So you need to be very careful about this. I have a kind of emotional attachment for Alibaba. It performed quite well for me. I still check periodically the price of the stock as I think that it is still undervalued, but there are big risks that I did not consider while holding it. But once out, I became more objective about the company and also of the potential risks involving China and future geopolitical tension between China and US. So I really need to be careful about my emotions when I will look again into this company. And with that, guys, there you have it. The entire list of emotional biases in investing. As already said at the beginning of the video, you can have the PDF version of this checklist by going in the description link below, subscribing to my free community where we will discuss all about finance and investing, and by sending to me a DM saying, please send me the PDF of the emotional biases, and I will do it immediately. But for now, I wish you all a great day and we see you in the next video. Cheers.